Let's also invite Rajesh Kothari, the Managing Director at Alf Accurate Advisors, on the show now. Rajesh, afternoon, and thanks for joining in. You know, for the last few days or weeks, the narrative has been India's outperformance, its resilience, the fact that it's possibly decoupled from the rest of the markets with the kind of outperformance we've clocked in. But the truth is that even if the markets can decouple over the short term, economically, we're still very much linked to the rest of the world, and those linkages cannot be broken. So considering all that, the turmoil that we're seeing, particularly in Europe with rising energy costs, the Fed is likely to continue to hike very aggressively, and therefore there is a possibility of a slowdown. Keeping all that in mind, do you think India can continue to, be decoupled from the rest of the global markets? What are the risks that you see now?
Well, I think, focusing at times too much on macros will lead to, the losing opportunities across companies and sectors where there are clearly India is coming out as a winner, on the global scale. If you think through it, if you look at the global markets, India was major exporter in IT, clearly number one. Second was pharmaceutical. India is considered as a medical store for the world. And third was textile. Over next 10 years, probably they are going to add another three categories. One is specialty chemical, second is electronics, and third, to some extent, maybe even capital goods. So I think India is changing. And when we look at too much on macro, the fear of recession, fear of increasing interest rates, fear of inflation, every country has its own, what I would say, equations, correct? And if you look at last 10 years, India inflation was 6%. Our current inflation is 7.2%. Compare that with US. Last 10 years, inflation was 0.5% and current inflation is 9%. Clearly two different economies, am I right? And same is true even for Europe. So I think, I'm not trying to say that India will be completely decoupling from the world, but at the same time, I would say that don't focus too much on macros on the world right now. If India as a country, if we do well, then surely equity market will do better than other markets. If other markets, probably after 6 months, US also inflation concerns will come down. And then US will also start behaving differently compared to what we are seeing in just last 6 months or so.
Okay, fair enough. Rajesh, hi, good afternoon. So, what's the kind of stocks that you are positive on? Anything that you've added recently since our last interaction, Rajesh?
Yeah, so basically, we keep, identifying companies in three favorite sectors which we like the most. One is specialty chemical, second is capital goods, and third is auto and auto ancillary. Apart from, of course, two major sectors which we own in our portfolio, that is banking and finance and consumer discretionary. So we keep identifying companies in this space. Like last time also we discussed at length about few of the companies which we continue to own. We continue to add those names, companies in fluorine, for example, SRF and Naveen and companies like that. One more company which we added some time back in our AAA mid-cap and small-cap PMS plan is a company called Apcotex. It's very good management, almost debt-free balance sheet, 18% ROE. The company is market leader, probably number one in the country in latex. And we believe that company is positioned for the significant growth opportunity over next 3 years or so. So this company is roughly, I think, about 100 crore profit-making company currently. And we believe this probably company can double its profit over next 3 years or so. So yes, we are basically doing bottom up. When we talk about these sectors, on these sectors, we are positive from the top-down perspective. And objective is to keep identifying companies which are clearly market leaders with the best of the balance sheet and best of the governance. And very importantly, strong earnings growth compared to normal GDP nominal growth of 10-12%. So most of the portfolio companies grows by 18-20%.
This Apcotex, Rajesh, it's done well over last 1 month, but and if 100 crores is the kind of profit you're expecting this year?
No, it will probably profit will double over next 3 years. So maybe we think that profit can be as high as 200 crores over next 2-3 years.
So then, relatively looks quite cheap, right? I mean, any sort of red flags here?
No, company has already made a profit of 100 crores last year. So from 100 crores to 200 crores is going to be journey over next 2 to 3 years. It's a best managed company. with almost like a debt-free balance sheet, as I'm talking about, and very niche player. Whether it is a cheap or expensive depends, how one looks at it. But as you are aware that we are a growth-focused portfolio with a very strong underlying business mode. Company's market leader, number one, with the zero debt balance sheet, with 18% ROE, and with, of course, strong earnings growth. If you put these four parameters in our investment framework, that's how it fits into our investment thesis. And with the entry into the latex gloves market, where probably the world leader, there's a company called Synthamor, is the world leader. The company's capacity is now coming on stream. And as that happens, the market size opportunity will be pretty large. It will be close to about, I think, 5,000 to 7,000 crore is the size of opportunity which they can cater to for the world market. And that can be a big growth driver for the company, in our view, over next 3 to 4 years.
All right, got that. What about from the consumer discretionary end of things, Rajesh? What do you like from there? If you can name a couple of stocks.
In consumer discretionary, there are a few companies which we already own, and we continue to add them. One is, of course, Trent. Generally people think that Trent is very expensive stock. People talk about 75 and 85 PE. But what we look at Trent is a little bit different. So if you look at Trent, which everybody knows, Trent buys Westside. Westside is the biggest, most famous thing, am I right? In FY18, Westside, I think, was having 1.6 million square feet under its bag. And come to FY22, you have a Zudio, which is 1.6 million square feet. So Zudio is almost equivalent to size of Westside, which it was 4 years back. So it means if you want one Trent, actually you got now size of Trent kind of thing, because Zudio is now equivalent to Westside 4 years back. And next 3-4 years, Zudio probably will continue to add another 1 million square feet. And of course, Westside will also grow organically. So that's kind of a growth I'm looking for. So I think this kind of a company will continue to grow at about 20-25% compounded over next 4-5 years. Clearly, the roadway is a huge opportunity from unorganized to organized. And they are very, very efficient retail player. So this is one company which we continue to like across our portfolio. And of course, there are many more selective consumer discretionary name which we keep adding. Like, for example, Safari. We continue to own Safari. There are only two companies in luggage. We really love oligopolies. One is VIP, second is Safari. We own Safari from quite some time, and we continue to like that name. So that's kind of a characteristics what we continue to enjoy in consumer discretionary.
Okay, Safari, Trent are some of the stocks that you like. Rajesh, just wanted to get your thoughts in on the MF data which came out earlier today. Equity inflows have come in at a 10-month low at just shy of that 8,000 mark. If you strip out the SIP figure, which continues to be steady at 12,500 crore, we are looking at discretionary spend, those one-time lump sum inflows which come into the equity market, being negative for the second consecutive month. What is happening from the retail front?
Well, I think probably retail is also becoming smart, and probably they are buying more at the lows, and as market goes up, they are a little bit staggering their investments, which is a smart thing to do from the retail perspective. But overall, if you look at in last 12 months, I'm sure everybody talks about it, the kind of money what FIs have sold in India and kind of money what domestic have invested in India, I mean, it's huge. And I think financial inclusion in the equity as a percentage of the total savings is going to go up. And we keep meeting a lot of investors, HNI, mid, small, all size. And one trend is very clear. Everybody understood that equity as an asset class, one should keep adding to, and any decline, they are going to take as an opportunity. That's what at least feelings what we get from it.
Rajesh, we'll leave it there today. Thanks a lot for joining us. Good talking to you as always. That's Rajesh Kothari from AlfAccurate.